take a deep dive into our world of wonderful markets. And
All
as
right.
we continue
I
down
am
this,
still unable to get to my live.
yeah, right. So as we continue down the journey of the markets today, we'd actually be able to start now going through, starting by currency data on its own, and what we've been seeing in terms of the currency markets. Now we have continued down the slide of the kwacha itself. It hasn't improved and hasn't reversed course. So we're still on day number 82 of the kwacha. But now here is some information that people may need to know. This is the first time the kwacha, in terms of the interbank rate, the interbank rate has actually traded above 19.05. Above 19 kwacha per dollar. And this is actually the weakest it's been. And this is the first time it's traded above 19 kwacha per dollar since before the president's inauguration, actually 18th of August 2021. So this is the lowest the kwacha has been since 18th of August 2021. And it looks like it's heading for worse days. So remember when we actually had the end of the election, the kwacha was sitting around 1930. Okay, so 1930, 1934, that's where the kwacha was actually looking at. But against the rand, we've seen 3 days of straight loss. So we are seeing positive trading against the rand. We're at a 52-week high against the dollar, while we are still below the 52-week high against the rand. Now, in terms of trading positions, we are seeing that dollar is up year to date 5.3%. While the rand is up the rand is only up 2.09% year to date. And we are seeing that we're trading way above the 200-day moving average, but which is moving in a positive direction, meaning that dollars are getting stronger. So defensive assets are still performing quite strong. Now we're also looking at the fact that the kwacha is overbought. The dollar is currently still in an overbought position, but we are still waiting for when that will actually reverse course. It'll take a lot. It'll take whatever is driving this momentum, because what we don't want to see as a country is that for sentiment to start driving this momentum as opposed to just market forces of trade. Now, remember, last month we did see our first trade deficit. So we are in a negative position on trade, and we have low output in terms of copper companies. So that is one of the reasons why we are seeing this kind of downturn when it comes to our position. Now, taking a look also, quickly, Vernon, at things such as taking a look at the commodity section or the global section of the markets. We'll get into what bonds look like, because we do have an auction coming in less than 3 weeks. We have an auction in about 2 weeks, and basically in 3 Fridays from now, we'll be seeing the second bond auction. You want to make sure you've got through your first one and get to your second one. But yesterday we did see copper bounce back at about 0.74. 0.74% to 9,278. Copper still up 10.8%, looking at the potential for royalties, for mineral royalties, and also to encourage the companies to start mining more copper and extracting more, or at least exporting more. We did see oil also bounce back up to 85.85, up 1.12% yesterday, but it's still down 0.07% year to date. Though we did see some movement in the oil markets and the oil price yesterday, and we will talk in depth about that. But we did also see gold moving at 5.56%. Year to date, and up 0.25%. And if you're holding gold in kwacha, you're seeing your portfolio of gold went up by 0.59% and up 11.15%. So you did see that defensive assets are holding, industrial assets are picking up, and we did see that inflation is starting to become a risk again, and it's starting to rear its head, and we will probably see H1 short-term inflation playing quite a strong role. Now, if we're looking at the rest of the commodity, if we're looking at the rest of even the bond market, going back into the fixed income market itself, we did see that we continued down the 0.6% movement on the bond. 0.6% movement on domestically secondary market traded bonds. That actually pushed up the market slightly. And it has continued to move up in that fashion, but there was a little bit of a sharp movement as of yesterday. We did see that the secondary market for bonds, we were reading the wrong index there. Apologies for that. But looking at the secondary market for bonds yesterday and where it closed, we did see actually a strong 0.51% movement, which is much higher and more pronounced, which is signs of bond buying. Okay, that's what we need to look at. There are signs that we are seeing buying actually happening that happened yesterday in the bond market, and we did see interest rates push downwards a little bit. So we are seeing that our bonds have been going through a mini rally yesterday, because even yesterday our yield to maturities dropped down from 23. Remember, our yield to maturities were 23.64% at the beginning of the year. Now they've dropped as low as 23.13% year to date. So we are seeing signs that bonds are in buying posture on the secondary market, and there is some positivity towards that. But now that doesn't mean that we're all out the woods. Remember that we're still in default status, and that is giving us a problem. And also our currency is causing a nightmare on the whole bond market. However, in dollars, we're still seeing negative positions coming out because of how weak our currency has been. So even though the bond market is moving at a positive click, yesterday it did have at least a bit of a reversal. It did have a bit of a reversal effect on our secondary market bonds in USD, on our USD index, but all it did was effectively just counteract what we lost on our currency position. So where we stand year to date is that our bond market is kind of leading us into a positive position. It's kind of leading us into a positive position for domestic investors. But remember that we're still trying to fend off quite high inflation, year-to-date inflation. Now, remember, as I said, the inflation that we saw, that we're seeing so far, I know that it said that our year-on-year inflation was only 9.4%. That's not going to be long-lived, simply because that 2.8% jump in inflation was really vicious month on month at the beginning of the year, especially driven by food prices. And we're probably going to see energy prices contributing to that as well. It's not a great thing. And especially because of yesterday's announcement, we're probably going to see even more energy-based inflation alongside food inflation. Because remember, Vernon, it's also not just the cost of growing food and the cost of fertilizer for food, but it's also the cost of moving food from where it was grown to where it needs to be processed to where it's going to be consumed. And that is huge costs in terms of the cost. That's huge transportation costs. And if we see the price of oil continuously going up, that is going to feed into things like sugar prices. That feeds into things like meat prices. That feeds into things like chicken prices, any prices. Okay, so it actually starts to play across your kitchen table whenever you're moving food around. Remember that you see this even in the financials of all these major companies. They'll tell you that when you start seeing higher prices of fuel, you'll start to see that they're having what's called margin compression, which pushes them under pressure to raise their prices in order to stay profitable. So this is where the struggle starts to come, because what you need to understand about businesses, and what many people need to understand about businesses, is this. The business is not in business to just give out money and give out things. They're not charities. They are primarily in business to make a profit. Okay? And what we do to regulate businesses need to make a profit is that we make sure that they have competitors. Of course, unfortunately, our forces have not done well in ensuring that they have healthy competition that keeps prices and margins under control. But a business is primarily where it is because it needs to actually serve its shareholders to make a lot of profit, but also make sure it serves its customers in order to make that profit. So there is that kind of balancing act that happens. But if you start seeing fuel prices start to transmit through, especially the food-based companies, we will start to see a lot more food inflation that'll probably jar into the economy throughout February and into March, especially if you look at month-on-month figures. You've got to be careful. This is why we're talking about base effects. The base effects, and I want to explain this quickly. Base effects that led to that 9.4 inflation read were this. Last year in January, you had 2.9%. You had about 3% monthly inflation that got packed into the same inflation that happened that goes from December to December. Okay, so inside that spectrum of December to December was a 3% jump in the cost of living, and also another one that came in February. So you had these huge, harsh jumps that came in January and February. Okay, those were factored into the 9.9% of December. But what you now found was that when you read January to January, we've removed that first January huge 3% inflation. It's gone. So we're starting from a higher level. That is what we call base effects. That's why the inflation rate is lower in terms of the annual one. But when you're trying to track the inflation pressure that you are feeling as a consumer and what we're seeing in terms of expectations towards the end of the year, we use the monthly versus the expected. When we take the 10 years before, we find the average for January, then we look at what that is today, and then we're able to say, based on that, we're seeing that it is a more inflationary month. So, yes, we are seeing quite a bit of inflation pressure building up at the beginning of this year, without even to remember the fact that we still got tariff hikes in electricity that have to now factor into the system. We still have obviously fuel that is wreaking havoc into our system. And then we have a currency that also won't stop going downwards and seems to be perception driven. And it's going to take the central bank to have to step in to wrangle perceptions. Because at this point, it starts to look like we're starting to have a few speculators in the market who are then playing against our currency. And therefore, the only way to wrangle them out is to make kwachas a bit more expensive. But that has the negative effect of making it a bit more expensive for people to access loans. So this is the kind of balancing act the central bank has. So the calculus of central banks not hiking rates because inflation is under control may be in question. You may see the central bank in February, if not March, have to step in to make this happen. So now let's take a look at some of the data at some of the stories that came out yesterday domestically. I think a lot of people want to really break into that. First story, obviously, is that our oil price has gone through the roof. We're back over 27. And yesterday we had a statement from the ERB that announced that the petrol prices were up way more than we expected. We expected them up by 55 ngwe to 98 ngwe, while we saw them up over 2.72, 72 ngwe. What was the issue? Well, the ERB had stated that though crude prices, and we did the average, crude oil prices or Brent oil prices had risen by 2.93% during that period, the average. While we also saw that the kwacha, in terms of us as a currency, had lost 5.91 or at least dollars. Remember that you have to buy dollars in order to buy oil. So there are two transactions that take place for an oil procurement company. They first have to buy dollars with kwacha, then they have to buy oil with those dollars. So there are two transactions that take place. So when you see the price of oil going up in dollars and the price of dollars going up, then expect that to reflect. So we expected that to reflect into about a 3 to about 4% rise in the price. We were not expecting such a huge jump that we were seeing in the price. So when you go up to the oil price, I think we're looking at somewhere about 2.72 kwacha increment on fuel itself, that led to a new price of 27.21. Now, the price of 27.21 obviously is quite an enormous jump. It is about 11% higher. So what has led to what we thought was a 3% price to an 11% price upwards adjustment, which is going to reflect in the cost of transport. Transport has stopped resisting price hikes. It has stopped becoming resistant to price hikes. It will start to reflect, especially in our transportation costs, whether it's our short-term transportation costs, whether it's our taxi services, and especially trucking services that will move food and freight around. Those are the ones that are the most likely to result in high transportation cost inflation. So what is the main factor? Well, it looks as though the Energy Regulation Board cited that the finished goods petrol was coming in 12% higher. Okay, that's what they were citing, that it was coming in 12.2% higher, which actually means that above this 2%, and this was in dollars, above this 2.93%, it seems the processors are facing high costs in processing. So somewhere in processing and distribution, okay, processing and bringing the actual oil into Zambia at landed cost, that is where the cost, an extra 9% processing premium actually came in. So how do we address this as a country? Well, what we have to start addressing, Vernon, is we have to start looking at how to either reduce our supply chains and make our oil procurement much cheaper, or we have to find a way to make oil, or we have to find a way to start working on where the sources can be that it can be cheaper. So there are three things that we're working on as a country, three things. And one thing that can actually end up happening, which is most likely to happen in the short term. The first one is obviously the speech with the president that he has been dealing with Angola to try and get their oil into the country. Now, that is going to take 5 years. That's not going to happen next week. That is something that's being dealt with by the Sangol transaction, where we've actually said that we're going to be investors in order to try and get oil from them instead of Saudi Arabia. Now, what do we do? What is going to happen there? Remember that the refinery has to complete being built. That's only going to be online by 2026. At the same time, we have to make sure that the Lobito corridor is open. Transportation on the railway line can get to Kolwezi, so that it can get from Lobito to Kolwezi, and then we can go from Kolwezi to Solwezi, which gets us oil straight through that point. So that is an issue that has to be dealt with, and that's going to take about 5 years to actually work on. The second one, obviously, is that pipeline, which they were talking about, that diesel pipeline, which has gone quiet from Tanzania to try and get diesel, because diesel is now sitting around 29. So this is why I'm saying trucking costs are going to be through the roof because diesel is very high, sky high. Okay, yes. These are seriously record high diesel. But remember that this is not us. I keep telling people when it comes to oil, remember, we don't make it. And I know people are going to say, but what about the old government's days? How come no one said that? Well, I always say this. When it came to the old government, the old administration, they were presiding over very low global oil prices. Oil prices were $65 under the old administration. So they were struggling. They were struggling to contain these things, and they were actually ending up paying high subsidies for it because they had a very weak currency and they were still presiding over low prices of oil, but they were still managing to mess that part up. So this is a very tough spot. We have to, as a country, reorganize our supply chains. The third thing we're supposed to be working on, which was a policy change, which was promised to the people, was that there was that issue of sugar. Okay, sorry, not sugar, ethanol. Ethanol being used to actually help blend semi-finished products, and that is what Indeni is supposed to be doing. So in order to bring down the prices, Indeni is supposed to get involved in order to get involved in the in the production of semi-finished products, to also help with molasses trading for Zambia sugar, and also cassava-based ethanol, which is supposed to be done in Luapula. Now, we don't know why that's taking long. That is supposed to have started in September. These were announcements, sorry, not September, in December. These were announcements that were made also by the president's speech, and also in the budget, and also by the Minister of Energy. So we're waiting to see the actualization of those things, those pronouncements, because that is supposed to make sure that there is a local component to these processing costs. Because as I've said just now, Vernon, it's the processing costs which are giving us a nightmare here. It's not the global costs of crude. It's the cost of turning crude, refining it, and then sending it to Zambia, where there's a huge cost premium that caused a 9% month-on-month price jump. Okay, that's a big one. That actually now is going to transmit through our economy. So that's a huge part. Now, the other part that we can try to work on is we can try and work on the cost of oil, but then we also have to try and work on the cost of dollars. That's where the other game is coming from. And the only version to work on the cost of dollars is one, to bring more, is to offload more dollars into the economy. The central bank has to try and play that role. But right now, remember, they're in the middle of a debt negotiation and they need those dollars in reserve. So the most likely thing, if this kwacha continues running the way it is for the central bank governor and his team to then have to start looking at the interest rates. Now, they will cite financial fragility as possibly something that might be an issue. But let's now go on to the other side of talking about what they think is financial fragility. Yesterday, we did start to look at aggregate data from the banking sector. Okay, so are we going to raise interest rates in order to curb the movement of the currency, which is now starting to play into the inflation of the country, and therefore starting to play in terms of oil and imported goods, and us now starting to import a lot more inflation through our currency? But let's take a look here. Well, the one thing I can tell you is that the banking sector is very healthy, Vernon, very healthy. The top 5 banks were analyzed yesterday, and they are ranked as Zanaco, Stanbic, FNB, It was Aramco, Stanbic, FNB, Absa, FNB, Indo Zambia. And they are ranked that way by revenue, ranging from revenues all the way from about 1.8 billion to about 4.3 billion. Was Aramco having about 4.4 billion in kwacha in net revenue, and all the way down to Indo Zambia with about 1.5 billion kwacha in net revenue. And you've got that across with Stanbic with 3 billion, Indo Zambia with Absa with 2.9 billion, FNB with 1.85 billion kwacha in revenue. But when it comes to profit, I think that was the big number yesterday. Everyone was looking at the profit numbers when it comes to banks, and you saw that the number one bank when it comes to profit after tax was Zanaco with about 1.35 billion. Number two was Absa. Number three was Stanbic with about 1 billion, and number four, obviously FNB, and then Indo Zambia Cable with about 480 million kwacha in profit. But here's the number I want to look at, Vernon, when it comes to these banks, is the profit margins that these banks are operating with. Because everybody's talking about the profits. I did some calculations on profit margins. And if you take a look at these profit margins of these banks, they're huge. These are gigantic profits. You don't see many companies operating with this. So this is what we did when we ranked profit margins of these banks. And we found that number one bank by profit margin, and what I mean is net profit after paying taxes. Now, I just want to give everyone this calculation. Profit margin means the percentage, okay? This is what you need to understand. Profit margin is the percentage of the net profits after tax of the total revenue, okay? Just think about that. The percentage of the net profits of the total revenue. And here are the profitabilities of these banks. These are profit numbers, by the way, Vernon, that are higher than US banks, higher than banks like JP Morgan, higher than banks like Bank of America. These are really high. And you can see number one there is Absa, 45.52% in profit. I just want to put this in your mind. In other words, out of every kwacha made in revenue, 45 kwacha, every 100 kwacha made in revenue, 45.52 is sitting as their profit. Okay, that's how much money these people are making in terms of banking. FNB number two with 33.94. So you can see the jump that Absa is. Absa is like a super profitable bank, like really profitable. You can see FNB with 33.94, Stanbic with 33.33, Indo Zambia 32.2, and Zanaco, who is going to be at the highest profits, is actually the least profitable. Okay, so there's a difference between profits and profitability. Profitability is the percentage of your revenue that is profit, while profit is just the actual number itself. And you can see that Zanaco, yes, is making more profit, but they're doing it taking more risk as a bank. So remember that as a bank, they're issuing more loans, they're taking more risk, and therefore they're taking a higher position. So that's one of the stats that we may have not seen. So this is the top banks in terms of profit margin. Now, in the end there, I just wanted to show you that even the banking sector itself has got a profit of 28.71%, and versus last year at the end it at 28.02%. So you actually can see that there is a huge profit position of banks as a whole. Now, this leads to a few questions, Vernon. I think one of the biggest questions is it ethical? Because everybody kind of gets worried when you see banks making such huge profits, but the rest of the economy is not growing. Because some of these profits may come at the expense of access to capital for smaller businesses. It may come at the expense of high interest rates. This is a result of also a high interest rate regime with a low inflation regime and with banks that are flooded with savings. So therefore they can keep savers at very low rates. And therefore you've got that distance between what banks are lending at and what they're receiving savings for might be an issue. Now, remember that when it comes to banks, and I'm going to give you a little bit of data here when it comes to banks in the financial sector, which we don't often pay attention to, is that it also has to do with the fact that in the banking sector, we got some data from NABSA recently in terms of the financial position of NABSA, which is your pension, Vernon. How long have you been working, my brother?
For quite some time now, a few years in the industry.
So you've been contributing. So do you know where your pension sits? Because NABSA is your pension. Do you know where it sits? Do you know where the money in your pension fund sits?
Where is
do
it?
you just throw it there and start paying?
Well, in my view, I'm giving NAPSA. So
Yeah, and this is where the problem comes. You people just give money you don't know. So some of the actual things I also wanted to take a look at is where NAPSA is sitting in terms of the health of its finances and how strong it's going to be. So we did get some data regarding NAPSA's position, and what we found was NAPSA is currently holding 65 billion kwacha worth of assets, of which quite a large chunk of that is sitting as financial assets, which you should be looking at. I'll be sharing that information right around very soon, and I think I've shared it even on my page. But the biggest position, one of the biggest we saw with NAPSA, especially that affects some of this banking data. 1 in every 3 kwacha deposited in a bank, in a Zambian commercial bank, or what we call a fixed deposit. 1 in every 3 kwacha sitting in a Zambian bank was deposited by NAPSA. Okay, that's how big these guys are, and that is the level of market control that they have. So, and also the same thing can be said also with government bonds. That 1 in every 6 kwacha distributed in government bonds is currently held by NAPSA. So that's how big their portfolio is. About 60% of NAPSA's portfolio, 66% of NAPSA's portfolio is sitting in fixed income assets. In other words, bonds, treasury bills, and fixed deposits. So the growth rate on their money may not be that great, but they do have a huge position, mainly because of the fact that they're still getting inflows of capital. So here's where NAPSA's position stands. If you're looking at the facts and figures of your NAPSA portfolio. So right now you're seeing NAPSA's portfolio, 23 out of that 65 billion of NAPSA, 23.4 billion kwacha is sitting in government bonds, 14.9 billion kwacha is sitting in fixed deposits, 7.53 billion is sitting in property, 5.85 is sitting in treasury bills. Only about 4.91 billion is sitting in the stock in the stock market or equities, or what we call even private equity, 4.5 in infrastructure, and 3.74 in what we call greenfield projects. These are fresh projects that they're trying to work on with only 0.37%. Now, they did cite that they've got 965,000 members who are actively contributing, of which 95% of those come from the formal sector, though they've been trying to push the informal sector to start contributing to NAPSA. It would be wise, by the way, for the informal sector to try and get a lot more into the contribution of NAPSA, because the people who earn the lowest actually benefit the most from NAPSA. It's not the people who earn the most, actually the people who earn the lowest who benefit the most. And NAPSA is designed in such a way that the rich are effectively subsidizing the lower income. That is actually what is happening to create a fair pension system. Now, the total contributions that NAPSA is actually receiving, Vernon, hold your breath, is 6.7 billion kwacha. Okay, 6.7 billion kwacha. Do you know, Vernon, that that is equal to the free float of the stock market? In other words, the tradable value of the stock market when you remove ShopRite. Like when you remove ShopRite and you ask, what is the tradable value, all the shares that are available for purchase and trading on the stock market, it is somewhere around 6 to 7 billion kwacha. So NAPSA's annual inflow is just that much. Now, outflows, they've got about 22,580 pensioners. In other words, they've got a net contributors rate of about 940,000, 943,000, 42,000. So in other words, they've got quite a number of people who are still contributing. They're not like the American system where there's too many pensioners versus people contributing. So what ends up happening is the money that comes in goes straight to paying pensioners, and the government has to kind of fund the gap. Right now, what we're seeing in NAPSA is that the money coming in is still way more than the money coming out. So about only 1 billion kwacha left NAPSA last year in terms of payments, 596 million kwacha in payments to those pensioners, and about 499 million kwacha in once-off lump sum payments to either deceased people, anybody who had to claim early, or those Zambia Provident Fund people. So it was those early withdrawals or any premature withdrawals that had to be done that led to about 499 million kwacha worth of NAPSA withdrawals in terms of lump sum withdrawals that were done. So as a result, what we're seeing right now is that with 6 billion kwacha in contributions plus coming in, there's still about 5 billion plus in net, 5.7 billion in net contributions coming into NAPSA, making them the juggernaut of capital. So we still have a huge inflow of capital, but the majority of that is getting funneled into GRZ bonds, fixed income, fixed deposits, and then they're also doing some other transactions. Obviously, properties. Remember that they were launching hotels. They've got private equity in those areas, but the majority of it is going into the bond market, treasury bills, and deposits into banks. So that's where your pension money, by the way, Vernon, is going, and that's what I've been pulling out in terms of data for all of you to take a look at. So, in other words, if we're going to say we can't raise interest rates because banks are in a fragile state, NAPSA is funneling money into these banks, okay? Funneling money, right? They are oversupplied. They're only starting to pay back the money that they were getting from the BOZ. And two, these banks are making 45%, 30 to 45% profit margins. Exactly how fragile are these people for us to keep saying there's fragility in the finance? How fragile are they? And for them to start saying, well, if you raise the interest rate by 1%, we'll stop lending to SMEs. Are they really lending to SMEs? That's the thing that we have to try and work out, obviously. Now, some of them are trying to turn a new leaf. Yes, that is part of the game. Some of them are trying to turn a new leaf, and we've got to start making sure. But one metric I would really like to measure banks by, and I think we should start to push it, is how big is their SME portfolio and what percentage of their loan book is their SME portfolio. I think that banks should also start getting scored by that. In a time of ESG, where we're talking about environmental social governance, I think it's only fair that the banking sector also starts to get ranked according to how much they're contributing to bottom-up economic growth, not just top-up capital, bottom-up economic growth, financial inclusion or let me not say financial inclusion, economic growth inclusion. How much are they contributing to that should be how well they're also scored and should play well in how well they're also being looked at. I think that's a metric in as much as we're looking at shareholder value. Remember that we're now in the regime where we're looking at what we call the triple B, the triple bottom line, or the triple P, which means profit, people, planet. So how well, one, are these banks playing for profit? Evidently, they're doing well in terms of profit. That's not even a question. But how well are they doing for people? In other words, how much capital is going to supporting people and how much capital is going to supporting the welfare of the planet? In other words, what is going towards loans towards alternative switching? You have seen some banks now issuing loans for climate, for alternative energy or green energy for homes. So just some data to look at for our minds, and just also I wanted to go through the transaction from Puma. But Vernon, I wanted to ask you very quickly, brother, before we kind of lose a bit of our step here. What are your thoughts? One, we've got that huge oil increment which happened yesterday. Plus, now we've got the potential of either they're going to start mingling ethanol quickly, or they're going to start raising interest rates. And secondly, your views on how banks are doing.
Absolutely. The funny aspect is that this comes at a time where we're just coming from January, and January being an interesting month order, had its challenges, January blues and whatnot. Having this increase, with fuel pump prices, very drastic increases, unlike when in times to reduce, they reduce a very minimal, increases. And I'm not really sure what the trajectory of the utility firms is trying to really embark on, of increasing of as much as 37% on electricity tariffs. We understand, of course, it has challenges when it comes to debts and whatnot, and we're not going to put ourselves in such a situation just to alleviate, the utility firms, debt position in that regard. But of course, we're coming this, a trajectory that actually trying to look at, and just how we're going to prepare the oils. Now that the prices have been adjusted. I should think we're likely to see the marketing oil companies, releasing fuel now and I'm sure they're likely to make profits, knowing that it has been adjusted upward, and so they're likely to make more profit as compared to when they would have just kept it in flow and pretty much in supply. I think that should be the situation. We're likely to have it in abundance, I would say, but then it will be at a higher cost, of course.
Well, come on, Vernon. I think we spoke about this. I told you that they were waiting for the increment. They knew that the increment was going to be much more profitable for them. So think about it. If you got oil that you were profitable at for 25 kwacha or for 24 kwacha, doesn't it make sense to then wait for it to get to 27 so that you can make an extra 3 on that stock? So that you can make extra money on that stock. Like, doesn't it make sense for you to kind of just hold off and say, let's wait for this price to go up? I mean, okay, let me ask you this question. Say you bought tomatoes that you could sell at 5 kwacha per kg. Okay, right now I know they're 19, but let's just use a number. Okay, let's use 19. You bought them at 19. You get news that tomato supply is going down and prices are moving up to 24, 25 kwacha. Would you sell your stock at 19 now, or would you wait a week because you can store them well? Would you wait a few days for the price to go up? Would you sell it today? So if a customer came to you today and said, Vernon, and you buy your tomatoes for 19, and then someone says, Vernon, just relax. Prices are going to be 25 tomorrow. Okay? Would you sell the stock for 19 or wait till tomorrow to sell it for 25? What would
Absolutely. You hold on to it.
Milton Friedman said this very interesting statement. He said, when people complain about inflation, here's what they're saying. They're not really talking about inflation for everyone. They're talking about inflation for themselves. Here's the reality, Vernon. Inflation is, I want the price of the things I sell to go up, and I want the price of the things I buy to go down. Okay? Everybody has a very selfish approach to inflation. You want your wages, okay? Because I'll tell you one, the reality is, Vernon, everybody who is employed sells their time. You don't want the value of your time going down. How many people go to their boss and say, boss, the cost of living has gone down. Now I can take a pay cut. Don't worry, boss. How many people do that? No one does that, okay? We all know that no one, okay? So the reality is you sell your time. When you're employed, you're selling your time to your employer, and you still want an increment. Even if inflation is 6% or 1%, even if inflation was 0, you still want an increment. You want more money. You want to have more things available to you, and you want to be able to purchase more. So the reality, Vernon, is that people want the cost of the things they're selling to go up, while they want the cost of the things they're buying to go down. Okay, that is what people complain about with inflation. They don't care about the next person. They don't care about their customer and reducing cost. The only time people reduce cost for their customer is when there's a competitor threatening them. That is the only time. But absent of a competitor, no one drops their prices. They want to make a lot of profit. And that is the nature of humanity. We want a lot. We want to make a lot. So that's just something I wanted to put in everyone's mind as we're looking at all this data and some of the major news stories that we covered here. One, fuel prices up 2.72, up basically 11%. So that is going to transmit through the economy. And our country has got the option. One, we have to wait 5 years to get our fuel from Angola. We have to try and work on that diesel pipeline from Tanzania. We've got sugar and ethanol, which comes from molasses and cassava, that we need to start blending in to reduce the processing costs, which are the majority of that price hike. It was not the crude oil price. It was not the kwacha. It was really driven by the processing costs of where we are getting that fuel from. It becoming in much more expensive than we thought. And therefore, the central bank also has the option to now have to raise interest rates to rein in the kwacha, which is 82 days into deterioration, and it is too much. Now, the final thing, Vernon, then is, should they raise interest rates? They've often been citing this fragility in the financial sector. Is there fragility when banks are making 30 to 45% profit margins? I think not. Okay, JP Morgan is on 30% profit margin, and then our banks in Zambia are making 33 to 45% profit margin. I think not. Is it going to affect lending to smaller businesses? most smaller businesses are getting their money from the government having to issue out citizens economic empowerment loans. It's still not getting it through the banking sector. It's going to take a bit of time for the banking sector to start lending downwards into the economy until the bigger parts have gobbled it up. So probably the best move right now is probably for an interest rate hike. This is why the base case for me for an interest rate hike has started to change. I'm starting to shift to think that right now, with the inflation that's about to rip through the economy in H1, and therefore the distress that it's causing, and also the political problems it's starting to cause, you'll probably see interest rates start to pick up a bit.
Absolutely.
That's where I'll leave
That's very interesting. All right, thank you so
Right,
much,
everyone.
Mthwale, for
See you
another
tomorrow.
interesting segment. Thank you so much. You have yourself a good one.